So getting started, 2010 was a very significant year for beauty. I'm sure you all have seen the headlines. It was one of the biggest years for beauty. In the last decade, it was the second highest year for beauty M&A, and these are some of the most notable transactions that were listed. And it ranged from companies like Unilever acquiring Alberto Culver to some of the independent brands such as Philosophy and OPI being sold. And if these headlines didn't happen to get your attention, then the multiples certainly will as we go through this presentation. And so we're going to talk about what drove the activity as well as what drove some of those valuations. And if you ask yourself, why was 2010 such a big year? Well, if you think about it, a lot of large beauty players came out of the recession having gone through a period of cutting costs, and there was very little ability to drive earnings growth from just margin expansion. They needed to find top line growth. The beauty industry in the US is projected to grow more slowly than in the next 5 years than it has in the last 5 years. So these companies have to find other ways to grow. They are looking both to grow internationally, and acquisitions are an imperative for them to fill the gap to continue to fuel earnings growth. So as you think about exit, while some of the most notable headlines had to do with M&A transactions and sales of beauty companies, there are a number of ways that you can think about monetizing or exiting your business. And I'm going to go through a couple of them here, and then we'll get into some specific examples. First of all, a sale to private equity, which is the first one that's listed. This can be either a minority or a majority sale of your company to a private equity firm or a financial sponsor, as we also refer to them. And here, this provides growth capital to you to accelerate the growth of your business, to fund the business, as well as may provide liquidity to the owners. It may also add operational expertise and insight from that private equity firm having investments either in consumer generally or beauty specifically. And the downside for you is the dilution. You have to give up equity in your company in order to bring on this partner. And so the key question we often get asked by companies in the space is, what's the right time? You want to do it at the time where you can really maximize and optimize your growth, but not so early that you give away too much equity. So we'll get into that as we go on. The second one is dividend recapitalization, and this isn't a traditional exit methodology. What this really is levering up your balance sheet by accessing the debt market and paying a dividend out of the debt that is raised. So you're not selling any equity, so the positive is that you get to keep the equity ownership that you have. The downside is you now have to operate a business that has leverage on it. So if your company has strong free cash flow dynamics and a great outlook, this could be an alternative to try to get some money out of the company. But if you are fast growth, then generally you don't want to lever your business and constrain yourself, particularly if we experience another downturn like we did in 08 and 09. The third one is an initial public offering. I think everyone's probably familiar with this, which is essentially just listing your company on a public exchange. The benefit is that it's a great branding event for your business. It's a way to incent employees as well as to monetize and provide liquidity for the original owners and provide capital for growth. But it tends to be a less traveled path for beauty companies because there are certain size requirements in order to pursue this, and I'll get into that in a minute. And the last is the sale to strategic buyer, which probably doesn't need any explanation because all the headlines explain that on the prior page, which is the most frequent type of exit and is one where you fully exit, potentially have an earn-out where you can participate in some upside, but in generally this is when you exit your investment. So I wanted to provide to you some specific examples of what brands have pursued these various paths. And it's arranged by columns, so all of the companies that have pursued a sale to private equity, minority or majority, dividend recap, IPO and sale. And I've done this in this order because a lot of companies pursue private equity early in their growth and then ultimately later work with those firms to then pursue the other alternatives. So some of the most visible and successful exits, if you will, have been companies that have had multiple bites at the apple. And we have all are familiar with, for instance, Bare Essentials that sold to private equity, then did a dividend recap. Actually, they did 3. And then went public at a very strong valuation, and then ultimately sold to a strategic buyer. I can't think of another example that did all 4, but they are probably the most notable. So Again, bringing on private equity early can be a way to really help open up some of these options for you later on. But then in the case of OPI, they went straight to a strategic sale and did quite well, so it's not necessarily that you have to go to private equity before you pursue these other alternatives. So I think probably the main question everyone wants to know is, if you pursue one of these paths, what does that mean in terms of what kind of valuation you can achieve? And we think about valuation, just to level set for everyone, and you may be familiar with this, but the way we think about valuation is a measure of the enterprise value of the business, which is the equity value plus the net debt, divided by sales or divided by EBITDA. And EBITDA, earnings before interest, depreciation, taxes, and amortization, and basically operating profit plus depreciation and amortization. And so these multiples here are EBITDA multiples. And what we've done is, without getting into how each market is valued, we've put them all on an EBITDA basis so you can see on a relative basis how they compare. So starting on the left, the private equity valuations, the bar on the left in each case is basically all deals. The bar on the right are some of the selected premium deals. So the point I wanted to make to you is that on the left, the majority or the density of transactions for which there were disclosed valuations, and in a lot of cases it's not disclosed. So I'm working on what's publicly available. So for disclosed deals, the density of valuations in selling to private equity is about 7.5 times EBITDA. For the companies that, and I'm going to get into why, but the premium deals, the ones you really hear and read about, the Bears, the Burt's, the Dell Labs, the Philosophy, the density for those deals is 9.3 times. So there's a big difference between where all of the deals are and where some of these premium deals are. In an initial public offering, there's a smaller group of companies that could access this exit, but the median for all consumer products companies was 10.9. For the 3 high-growth beauty companies, it was 16.4. And then on a sale to a strategic, again, the density for all beauty deals was around 10 times, whereas for a strategic, these premium deals, it was about 13.3. So I hope that's useful for you to understand that, again, the density of deals tends to be a little lower than what we see these really premium transactions trade at. And so what does that mean? Well, for you, what you need to understand is what's driving, how do you get to the bar on the right? How do you get the premium valuation? And what that means to you is, if your business has 10 in EBITDA, that means a difference of $20 million in a sale to a financial, $60 million in an IPO, and $30 million in a sale to a strategic. So it is meaningful to be able to move up the valuation curve. So I want to get into why and what drove the premium valuations. So on this next page, we list some of the key criteria, and you probably will look at this list and say, you know, well, this is kind of intuitive: market leadership, growth, et cetera. I mean, these all would seem to be important things that everyone would strive for. But let me give you some examples so you can understand what I mean by each of these and how important these attributes are. So number one, the deals that garnered a premium valuation had number one, market leadership. And that's market leadership in the market you participate. It doesn't mean you're number one in hair care, but in the case of Fakai, it meant number one in luxury hair care, 67% share of the luxury hair care market. That was meaningful to P&G as they thought about Fakai's position. A strong brand with distinctive positioning. You know, when we are advising and selling companies on the other side, the strategic buyers, they want to know, they're trying to figure out, is it a true brand? How much brand strength does it have? That is really important to a strategic buyer. And so when I think about great examples of this, to me, it's OPI, who's a leader in the pro nail market, or Behr, who created the mineral makeup market. The third is visible growth opportunity, and this can take many different forms. This can be channels, this can be further penetrating the channels you're in, growing to new channels, growing to international, expanding categories. It can mean a lot of different things, but a great example is Smashbox, who provided a greater emphasis on the growth retail and broadcast TV channels for Estee Lauder. Profitability. This is important. It is important that you operate your business profitably. Strategics in particular will look for that. Some of these other options aren't available to you if you're not profitable. You can't lever up if you're not profitable. You can't go public without a certain level of profitability. So that is important. And in the case of Behr, they had 21% operating margins versus Shiseido at 9%. So it was very accretive for them to do that deal. And then significant retail distribution potential. of all the deals we've looked at and spent time with, this has been one of the single most biggest drivers, which is where there's a really strong opportunity to take the retail distribution and expand it enormously, like Burt's Bees, that was authentic in the Whole Foods, had started to go into drugstores, but for Clorox could then take it into mainstream and triple the business by doing so. And the last one is proven internationally. And I put a yellow check on this because I think it's mixed. I'll be curious for Melissa and Steve's view on this too. The reality is Philosophy was really only in 2 markets, and they were doing that through QVC. I think they might have had some retail distribution in the UK, but they weren't very penetrated internationally. They'd done enough to prove themselves. And so there's a kind of a question. I think you need to prove the portability of your brand, but you don't need to be widely distributed. And it probably varies based on the space that you're in and the competitive dynamics. But I guess if there's anything you take away from what drives value, the #1 driver is that you're filling a white space for a strategic buyer, that there is a need at the strategic buyer that you are filling. So I think understanding your business, understanding the logical strategics will really be a key. And in particular, for Clorox, Burt's was their personal care strategy. For Shiseido, Bayer was the US retail strategy, not going head-to-head in department stores. And then for Philosophy, that was Cody's personal care strategy in addition to Lancaster that they have. Okay. Oh, gosh, I'm sorry. Now you can see what I'm talking about. I'll leave that up for a second. Oh, I don't know how to go back. I'll leave that up for a second. I'm going to talk about IPO so everyone can read that, and then I'll push it forward while I'm talking. When it comes to an IPO, all of the same things apply to drive valuation. But in addition to these key characteristics, you have to be of a certain size. You really want to, when you go public, have a a market cap of around 250 million to ensure that the stock has adequate trading liquidity. And so what that means is if you're able to achieve, say, a 25 times PE, you need to have 10 million in net income on a forward basis. So if your net income margins are 5%, you need to have 200 million in sales. So a lot of companies don't, in the beauty space, don't wind up pursuing this path until they're more mature, just because of the size requirements, in addition to the fact that a lot of growth companies don't want to operate as under the public eye and quarterly earnings and having to make short-term decisions versus long-term. The other key things are having a unique and defensible market position. One of the things an IPO does is it raises awareness of your success. And it's it's no coincidence that when Ulta went public, CVS launched Beauty 360. When Oriflame went public, Avon became very competitive for them versus Avon in their core markets. So sometimes going public, it's nice to be kind of a best kept secret, but doing really well. When you go public, everyone knows how well you're doing. Having a strong track record historically and projected, equity investors like to see companies that can consistently repeat their performance and continually grow. Having a multifaceted growth opportunity, so having perhaps wholesale, retail, channels, product categories, having a lot of different ways that you can grow your business, multiple brands typically within an IPO story, and then having a talented and experienced team, often with public company experience. And it's not just that the owners or founders are impressive, but that there's a deep bench is another thing that I think people need to see. So just to reinforce some of those points, I wanted to highlight the Ulta Salon IPO, which probably a lot of you are familiar with the company because you probably sell to them. But I had the good fortune of working with them on their IPO as well as a follow-on last year. And what kind of valuation did they drive and why? So Ulta was a truly unique story in the public equity markets and frankly competitively as well, combining mass, prestige, salon, and salon services under one roof. And so that was an advantage and a disadvantage as we told the story. It was an advantage because they were so unique and no one else was doing it that way, but it was a disadvantage because public equity investors, we had to educate them about the beauty retail market, about Ulta's position and how they were poised to take market share. Some of the key things that really sold the story were the growth potential, and for Ulta that was a lot about new stores. They were only 21% penetrated into their 1,000-door potential, and today they're about 39%, so it's still one of the greatest growth stories in retail. And they also had a strong and improving economic model that was built around improving their store economics as well as just their overall business, and that drove strong returns for investors. And so the net result was a very successful IPO. It priced in October of 2007, about a week off the absolute market peak, so the timing was really good. It priced at $18. It was a 31 times forward PE, which was, I think, the second highest valuation in consumer and retail over the last 5 to 7 years. And it traded up 65% on the first day. It was 21 times oversubscribed. So just by all measures, it was a successful transaction, and it continues to be a successful story today with the stock at $66, and it's returned about 265% to equity investors. But to make the point about why a lot of companies don't go this route, when they went public, their sales were about $830 million. So it was a large company with a strong growth opportunity. That's on the higher side of size with companies going public, but I just wanted to help everyone understand that relative to the alternatives. So I'm going to shift gears and talk about the markets and how to think about timing exit from a market point of view. And this page looks at the equity markets. On the left is the beauty index versus the S&P. Beauty has significantly outperformed the S&P, and we're at a peak. You can see in the blue line for the beauty markets. On the right, this is valuation multiples for beauty stocks, which are back to historical averages. So what does this mean? This means acquirers have more confidence, they feel good about their currency, the macro backdrop is better, and then sellers are more willing because where valuations are back at historical levels. And then from an M&A context, what we're showing you here is basically 10 years worth of data showing M&A volume just in beauty. And you can see what I said before about 2010 was a banner year for beauty M&A. It was the second highest, though. I didn't include 05 when P&G bought Gillette because it would mess up my graph. And then the row below that chart shows you EBITDA multiples, and you can see the creep in multiples over time, and the fact that today we're back at premium, back at peak valuations for where there have been disclosed deals. So we're at a very good point in time from the standpoint of sellers' desire to do deals where valuations are and acquirers' interest. And then the bottom chart I show you, it's leverage over time. This is just in the leverage loan market, what kind of leverage is getting done. And this was really from the 03 to 07 timeframe. This was the reason that multiples were creeping up. There were some visible successes with Burt's, and so a lot of private equity got into this, and they were able to finance these deals. They were outbidding strategics, and that's really what drove a lot of the M&A activity and valuations back in that time frame. Today we're back at we're still below that peak, and hopefully we stay there for a number of reasons. But in general, leverage is available to finance deals, but strategics are really the primary driver. So the last thing I wanted to share with you, and then I'll turn it over to Steve, is what we've got here is a chart of the top 13 players globally. This is actually ranked based on their market share according to Euromonitor, and their acquisition activity over the last 7 years. And I think visually it helps you see who's been active and who's not. And frankly, there's been activity across all of these companies. The most active have been P&G and L'Oreal. And then interestingly, the recently active have been Unilever, Avon, Coty, and Estee Lauder. So I think as you think about, back to the point of know your buyer, know what need you fill for them, now you can also have a view of who's active in the marketplace. And the final thought I'd leave you with is we did a study looking at within the broader household and personal care industry over the last decade. If you take the companies north of $500 million in sales a decade ago versus today, 35% of them have been acquired. So there's roughly 30 companies left around the world with sales north of $1 billion. And so for the top 10 players, there's only 20 companies to acquire north of $1 billion that are not in the top 10. So a lot of the consolidation activity, the major consolidation activity, has taken place in the industry. So the thought I would leave you with, it's really a strategic imperative for the larger players to look at smaller deals, and they're doing so. And you can see that on this chart with the types of deals that they're doing. So thank you very much. I'm going to turn it over to Steve, and thank you.